Hello everyone, and you're welcome back once again to LearnCity. In today's class, we are going to talk about floating interest rates. We are going to talk about how it works, the examples, and the introduction aspects. Now, let's go into the introduction of floating interest rates. Today, we are going to dive into the fascinating world of floating interest rates. And have you ever wondered how interest rates on loan or investment can change over time? That's exactly what we are going to explore in this lecture. Floating interest rates, also known as variable or adjustable rates. These are an essential aspect of the financial world, impacting everything from mortgage to student loan and government bonds. Now, let's go into the understanding of floating interest rate, the definition I meant. A floating interest rate is a type of interest rate that is not fixed but rather varies over time based on changes in underlying benchmark rates or reference indices. Unlike fixed interest rates, which remain constant throughout the loan or investment period, floating interest rates are dynamic and responsive to market fluctuations. That is, floating interest rate is not static. Anything that happens in the market will eventually affect it. Now, how does floating interest rate works? How it works? Floating interest rates are typically tied into an external financial indicator, such as the prime rate, the LIBOR, known as London Interbank Offer Rate, or Treasury Bill Rate. The interest rate on the loan or investment will adjust periodically, for example, maybe monthly, quarterly, or annually, based on the changes in this benchmark rate. Let's talk about the formula for calculating the floating interest rate. And the formula is quite straightforward. What you just have to do is floating interest rate, the formula is the benchmark rate plus the spread. Then the benchmark rate, in this instance, it represents the reference index, and the spread is an additional percentage that was added to the benchmark to determine the financial interest rate charge that was charged. Let's talk about the advantages and disadvantages of floating interest rates. Advantages of floating interest rates. Number one advantages, we have flexibility. One of the primary benefits of floating interest rates is the flexibility they offer. Borrowers or investors can take advantage of falling interest rates, resulting in reduced monthly payments or increased return on investment. The second advantage is market alignment. Floating rates ensure that the cost of borrowing or the return on investment, it aligns with the current market conditions. This alignment we are talking about, it helps to maintain fairness and competitiveness in the financial market. The third advantage is initial savings. Floating interest rates often start lower than fixed rates, making them an attractive option for borrowers who expect interest rates to decline in the future. That's that about the advantages of floating interest rates. Let's now talk about the downturns or the bad side or disadvantages or the demerits of floating interest rates. Number one disadvantages of floating interest rates is uncertainty. Uncertainty, the major drawback of floating interest rate is the uncertainty they brought or they bring. As they fluctuate, borrowers may face different kind of challenges in budgeting and financial planning. The second disadvantage is risk of rising rates. This is very common because while floating rates can decrease, they can also rise, leading to higher interest rates payments for borrowers and potentially reducing investment returns. The third disadvantages, which is the third one, is market dependency. Floating interest rates they are dependent on the performance of the underlying benchmark rates, making them susceptible to external economic and financial market changes. Having talked about the advantages and disadvantages of floating interest rates, let's give to better understand it, let's talk about few examples of floating interest rate. The first example is home mortgage. Many home mortgages offers borrowers the option to choose between fixed and floating interest rates. With a floating interest rate mortgage, borrowers can benefit from lower initial payments, but they also run the risk of higher payments if interest rates increase over time. The second example is student loan. Some student loans feature floating interest rates for students who can expect their income to rise in the future. This type of loan may be advantageous or merit for them, as lower initial interest rates can help manage loan payments during their studies. The third example is government bonds. Government bonds often come with floating interest rates, allowing investors to participate in changing interest rate environments. The interest payments on these bonds adjust regularly to reflect prevailing market conditions. That is that about the disadvantages of floating interest rates. Now, we've talked about the meaning of interest rates, how it works in the market, those that it favors, that is the advantages and the disadvantages. Let's now talk about the concluding aspect. Now, in conclusion floating interest rates play a very crucial role or important role in the world of finance because they offer flexibility and market alignment, but they also come with uncertainties and risk that applies with it. Because as borrowers or investors, it is essential to carefully consider the potential impact of floating interest rates on your financial decision, whether be it either mortgage or student loan or even government bond. Understanding the dynamic of floating interest rates, as we've earlier talked about, will empower you to make informed and prudent financial choices. Stay curious and keep exploring the fascinating world of finance. And thank you for watching. I'll meet you in the next class for another intriguing course.